What's going on, everybody? This is Cody Barton. Welcome to my channel, and we're returning again with Ira Sorensen. We're going to be talking about whole life insurance. We're also going to be talking a little bit about term insurance as well, but more specifically, what we're going to be talking about in this YouTube video is going to be how to utilize whole life insurance to invest, not just invest, but invest in multiple different types of asset classes. More specifically for this YouTube video, real estate, and how you can make more money, a higher return on the money you're already spending utilizing these policies. So we're going to jump right into it. Ira, thank you so much for being here for the second time. I'm excited to run through this with you and learn more myself too.
You bet. Thanks for having me. Excited to keep educating and sharing the message here of how to utilize these strategies to do more and create more wealth and do it tax-free, right?
Yes. I love that. Tax-free. I love that. So, let's do this. Ira is, I know, on the last one we covered some of the basics. So for those of you that didn't see the first video that Ira and myself did together, you can, the team will pop it up somewhere on the screen here, and you could, watch that one, come back to this one as well. So we talked about the basics. We're going to have Ira go into really fast the difference between whole life insurance and term. So I'm going to go ahead and share that screen here for you to bring that up.
Okay.
So we can jump right in here, Ira.
Awesome. Well, again, insurance is a very misunderstood product. There's many different mindsets out there between the different types. So, but just to keep it very simple, there's two types of insurance. You're going to have term insurance, and then you're going to have whole life. Term insurance is like renting, where whole life is like buying. So just like there's times in our life where we can rent, and we should be renting, where we're paying debts down and doing that approach, what we have on this side is then you have the opportunity to buy at some point. And there's times in our life where we should be doing both of these. But with term insurance, most people are familiar with term, but just to run through it real quick, with term, it's a set cost for a set time. So oftentimes you'll hear where you could get, a 10-year term, a 20-year term, a 30-year term. What that looks like is you've got your 10 years, you've got 20, you've got 30, and over these you have a set cost. And let's just say that and a set death benefit. And what happens is you have this value that you have to consistently pay. And so it's locked in. Say you do a 10-year, it's locked in for 10 years. But after the 10 years, it skyrockets in price, right? So same thing, you could do a 20-year term, but it's going to cost you more, and then it's set for this time. But then it's just going to go to the 20-year, and then it's just going to skyrocket. So the problem with that is short term, it's very, very inexpensive. It's if you pass away, obviously it's going to pay out. The thing that people don't realize is the percentage of those that will ever pay out. So if we have a little test here with you, Cody.
Yeah.
You guess the percentage of term policies ever pay out in all of term policies across the nation?
I would guess like probably less than 10%, just because of people just living through it and not having like an accident happen or something crazy happen where they pass away like in that time. But yeah, I'm curious to know.
Yeah, so it's very, very, it's a lot less than that. It's less than 1%. And the insurance companies publish this. It's published out there. That's where they make the majority of their money. Now they make money on the other insurance policies, obviously. But if you think of the billions and billions and billions of dollars that are spent on insurance every year, and the fact that they never pay out, because guess what? It's less than 1% will ever pay out. It's just nuts. But we know that, but we still buy term insurance. And I'm a big fan of term insurance. I'm saying term insurance isn't a good thing. I own term insurance. It's just there's times where term insurance makes sense. And then there's time where, in my opinion, the whole life makes even more sense.
Right.
Again, term is a good thing, but we want to work with convertible term. And convertible term basically means if you while you're in those renting years, if you have to get a term policy, make sure you're getting a convertible policy. I had a guy I just spoke with yesterday. We did a term policy last year and he did some whole life. Well, he had a scare with skin cancer and had to have a bunch of areas removed actually on his face.
Oh, wow.
And for him now, we're looking at it and he's in his late 40s. Now, all of a sudden, he's got a different look on insurance. And so we're taking his term policy that was locked in last year with a good rating, and now we're converting it over to whole life, and he maintains that original offer.
Mm.
So again, term insurance in that case, it's a great thing. It protected him in the tune of $1 million of coverage. So now we're converting over to whole life. So whole life is a totally different beast because now you have a set cost and it's set for life. The only difference is it's a higher premium than term. So if we look at this and we look at the way whole life works, basically you have this timeline here where you have your premium goes in and you have your death benefit. Sorry, that's kind of phasing that out. So your premium, again, never stops. So we have 10, 20, 30 plus years here. But now what happens is your death benefit, now you also pick up another line over here, and that's your cash value. So your cash value over time goes up, and then your death benefit also goes up. So again, it works opposite of term. Term only gets more expensive and your death benefit always just stays the same. So when we look at this, what can we do with whole life and what can we create? Well, our mentality and our mindset is totally different than most advisors because we want to have the death benefit in place. Obviously, God forbid something happens that it prematurely you can have a payout come into your family, but we want to look at it and say, how can we build long-term wealth and how can we have that long-term wealth be tax-free? So when we look at whole life, kind of picture it as a boat, and I'm a horrible artist here, but your base premium,
I love it.
Your base premium in whole life is kind of that boat. It's going to get you somewhere. It's going to float. It's going to go. It's going to be efficient. It's going to be guaranteed. But here's the problem with the boat. There's not much efficiencies with it. So what if we can put this massive sail on the boat? And this sail is a cash value rider. And that rider is something that when things are going great, we can leave that cash value rider up and it can go further, faster, be more efficient, build policy cash values in day one. And if times get tough, then we can pull that rider down or pull the sail down and allow that to run itself at a lower amount when maybe we don't have the cash flow. So if it's okay, can I show you an illustration, Cody, and kind of go through how that works?
Yeah, let's do it.
So here's where if we look in, and this is just a general, we got Jane Doe here.
Yeah, what are we looking at? Like what is this thing that we're looking at here?
Perfect. So what I did is I pulled a whole life illustration that kind of shows you the numbers and what it looks like if you were to invest and what that creates. So just simple parameters here. I did a 30-year-old female putting 20 grand a year. So if we look at these numbers here, what we've got here is we've got this guaranteed whole life. So here's your base policy right here. And then
so that's
we've got
the boat. Is that basically the boat?
Exactly. So
right,
this is the boat. This whole top section is really the boat. So we have a face amount here of guaranteed value, whole life of 327,000. Then what we do is we use a term rider within this policy to create the ability to put more cash in. One of the things that you have with whole life insurance is it is a tax deferred, tax-free vehicle. But of course, anything that's good like that, the IRS puts limitations on. So the limitation is you can only put so much cash value into these policies and avoid what we call the MEC, the modified endowment contract. So with the MEC basically says you can put money in, but you have to have a policy big enough to be able to do that. So what we do, you can see here that rider is double the base, which allows us to keep your premiums lower so you don't have a higher cost of insurance. So of the 20,000, you've got 4,200 of that is your base boat. Okay. So now if we come down here, here's where it gets exciting, because now here is this cash rider, the EPPUA rider. We can put up to an additional $15,703.09 into this cash rider or the sale. And now if you can just think of it, now we're going to go further, faster, quicker. We're going to build cash value quicker. We're going to have more efficiencies in the whole life. But again, the cool thing is with this rider right here in the sale is over time, if we can't do that, we could drop that to 0 at any point. And we could do that for multiple years. The only requirement is see this requirement right there. We just have to put $8,700 in that in a 5-year period to keep the ability open and that rider fully open to then go back to 15,000 additional into the cash value at any point. Questions on any of that or anything you would add?
Yeah. So essentially, just for, a reiteration of like cash value. So the money that you're putting into the policy, you're growing a cash value amount. And what does that look like? I don't know if that is something you're already going to show as far as like this money you're putting in, it's in the policy as a cash value that then you could take out, which is what we're going to be talking about in a little bit on more specifically around like how to use it to invest. But, it's like, okay, that money's going in, but like, where is it going? Like, I understand there's a cash value. This is just more for, people listening. It's like, where is that now? Where is it sitting? Like, where is that at now?
Okay. Yeah, let's go down to this ledger here, and this will kind of talk through the numbers. So again, when you're investing in whole life, you're investing in a whole life company, which is a mutual company that's paying dividends on their policies. So as you invest that money with them, just to be clear on this, you're investing in that company. And Penn Mutual that we're illustrating here, they've been around since 1867. So they've been through the Great Depression. They've been through recessions. They've been through everything. They, in my opinion, are a bulletproof company because they've been around so long. So we want to invest in big insurance companies. So if we invest with them, they're going to pay a dividend and interest. But this kind of gives you a breakdown of the values as you put in, like you were just saying. So this is the breakdown here, and not to get caught up in all the numbers. There's a lot of numbers. I don't want people to get overwhelmed by the numbers, a lot of moving parts. But in general, the premium breakdown, here is your boat, these two columns there is your sale for a total premium of 20,000. Now, the way the structure of the company works is they have to guarantee you at least 4%. So if they never paid you a dividend, which in the existence of Penn Mutual, they've always paid since 1867, they've always paid dividends. But they do have to show this as a worst case scenario that if you didn't get a dividend, they pay you a minimum of 4%. But here's where we're going to run over here and show the non-guaranteed side. Over all of that time period, these policies will average somewhere between 4 and 6% tax-free. So what we have over here is as we put the $20,000 in, if you can see that all right, in year one of that 20,000, look how crazy it is. We get cash value of $15,991, which I get feedback all the time of people say, well, I was talking to a guy and they were showing me a policy and I didn't have cash value for 3 years. There's all kinds of different permanent policies, and maybe we can get on another call sometime and I can share the differences. Just
be like a part 3 or something.
Yeah, because again, there's a lot of stuff here. But the value is right here. This is growing because we're using riders. We're not focused on the death benefit like most insurance agents are. We're focused on getting the cash value in there to create this bank and to create this infinite banking concept and get this value to build as quick as possible. Now you can see over here, even for that investment of putting that money in, we still get over $1 million of coverage, which again, God forbid something happens. What if you're a few years into this and now the family gets $1 million or $1.2 million or $1.5 million payout? That's going to be the greatest rate of return. Of course, we hope that doesn't happen earlier in life, but it's going to happen in life, right? There is that guarantee, death and tax.
Yep.
So if we look at this here, you can see it increases that first year by 15. So if we look at the next year, we pay that same amount in, and this is illustrating if we just keep doing the same 20. Again, we can have flexibility in how much we put in, but you can see in that second year we put in and see how it grows by 17,000 that year of the 20. And then the next year we put the 20,000 in and it grew by 18 that year.
And is that because of the dividends, right?
So it's not just the dividends, but it's the accumulation of the interest and the cash, obviously, that you're pumping into the policy. So where I'm leading this to is this year 3 to 4 for most people is where we want to be. Because if you look, now I put 20,000 in and now it grows by 22,000 in cash. Now I have a total of almost 75,000 that I've built up. So if we look at that, now every year after this, the cash value increase, it just goes crazy. It just grows by more than you're putting it in. To where if we come out here in 10 years, we put the same 20, now it's growing by 30. Just curious, what year, let's see on this illustration, if we put the 20 in year 15, in that year, see where it grows by
really
40.
Doubling your money.
You're doubling your money at that point. Where can you go get double your money on a very conservative,
Safely.
guaranteed policy, right?
Everybody watching this that's a real estate investor, I can double my money, but it's like, this is conservative, like steady, win the race for sure investing.
Exactly. But you can see in that 15th year, now look what our death benefit's done. Now we're up to 2.5 million of cash where we started with $1 million. So if I go back to that original illustration or the original drawing, you can see your cash value has gone up, your death benefit's gone up. And now what can we do with this over our lifetime? Because I'm not saying whole life is the fix all, do all, only invest in whole life. What I am saying, though, and what many wealthy investors do is they put this money into here, and especially in the real estate world. Let's just say somebody had 100 grand sitting in a fix and flip account that's earning next to nothing in that account. What if there's an option to pump money into this over a 5-year period with 100,000? Now all of a sudden, or 4 to 5 years, now all of a sudden you've got this value built up in here. And now you can always take up to 92% roughly of that cash value and take it out and go invest it somewhere else. Go, listen to Cody talking about the wholesaling deals and all the real estate deals. Now, what can you take that money and go do with it to create additional rates of return within your overall economy, right?
Yeah. So I know people are going to ask, like, okay, so you say you put in 20 grand and then, like, obviously say you put in 20 grand today, and then the cash value, obviously, if we look at that year one, it's $15,991. Like, how much of that and how soon can you take that out? If I put it in today, like, when am I able to take that out? And am I able to take all of that, or what's that look like?
Yeah, great question. So what happens on an annual basis, if you're making an annual payment, this value, that roughly 15,000, will show up 30 days later. And why 30 days? The insurance company wants to make sure that the check clears and that there's that settling time there. But once it's past that 30 days, I just had a client do this where they put the money in and then they turned around 30 days later and pulled it out and got it in motion for themselves into another project. And now they can pull that out and go do whatever. This value here, after 30 days, you can take up to 92% of that. And the reason it's 92% is you have to leave enough value in here to sustain the policy for the year and make sure that it doesn't have a problem or a lapse issue. So that's just a general thing that we say is it keeps 92% in there. But here's where it's fun, because now if you look at it, the 15,000, let's just say you come in here and take 15,000 out, that doesn't come out of your policy. It stays in your policy earning the full amount. You just pick up another line here that's a loan. And this is where the loans work unlike any other investment or instrument out there, financial instrument, is you keep your money earning in there and it still earns dividend and some interest. What kind of investment can you pull the money out and still have earning dollars on the amount that you have out?
So that's super interesting, and I know for people that are hearing this for the first time, they're like, what the heck, what do you mean? So could we do like an example where you could draw that out, like a sample situation of like, say I'm, obviously a real estate investor, say I have, $100,000 in cash value in my policy for an example, and I'm going to go buy, a property that I'm going to fix and flip. And instead of using a hard money lender where I'm going to pay 12% interest, I'm going to instead want to use my policy where I have the same $100,000 that I need and, lend that and charge myself 12%. Like what type of illustration, I guess, could that, look like? I guess, say we're at year 5 on here where it's just about 100,000, rounding to 100,000 just for the example.
Yeah, you were leading right where I was going to say. It's easy to have this conversation right here. Let's round that to 100,000. So let's say you could have that 100,000 here, and then you want to take out 92,000 of that roughly, because that's how much you can take out. But let's just use round numbers to keep it simple. You take 100,000 out here. Now you have a line here that shows up where you have the insurance company is charging you an interest rate on that. And again, this is where it gets a little confusing, but it's pretty straightforward. So let's just in easy math say that you're earning 5% on the policy, and for illustration purposes, now you've got the value there where you have the loan amount is at 5%. So in that example, let's just say that it's a wash. So you've got that money out and it's working for you, and now you go put it in. What kind of rates of return can somebody get, even a conservative number, in a real estate deal short term?
I mean, if they're just being a lender, let's just say they're not even like being the person that makes the profit on the fix and flip. Let's just say they're being a lender even, and they're charging 12% interest for the use of their capital.
Yep.
So that's pretty standard. I mean, 12 to 15%, private lenders can get that when they're lending on other people's deals.
Exactly. Okay, so perfect. So let's just say it's 12%. So let's just say that this is a wash now because you're pulling that money out. It's still in here earning. And now you have that money out earning that 12%. Well, now that value there, that's an additional 12% rate of return. And you don't have any additional costs necessarily to that because it's leveraged out of your policy. And now you have that additional 12%. So now over time, how can you then get that money back in here? Because remember, all this is going to grow tax-free and tax deferred. So now if we have that back in here, now you've done that one deal and it's created that 12%. Now get it back in there and pay yourself back. The cool thing is with the loan is there's no set loan amount. Like a car, if you get a car loan and you don't make a payment on it for 3 months, what do?
They're coming for your car.
They're knocking on that door. They're coming for the car, right? So with this, you set up your own payment plan. You set up how often you're going to pay back, what you're going to pay back, how you're going to pay back. Again, what financial institution allows that out there and be able to leverage your money out?
Yeah.
It doesn't exist. So people say, well, that sounds too good to be true. Why is the insurance company going to allow this? Well, the key is if you take 100,000, just round that up, out of here, your death benefit is going to drop down to now 1.4 million. And if you pass away, they're going to deduct that from that overall amount. So they're never at risk of not getting their money back. They're just going to hold it back. But for policyholders, that's where you can now create additional assets, additional rates of return. And it's this whole banking concept. Banks don't just let their money sit. I mean, of course, they tell us, put your money with us. We're going to pay you interest. And it's this miracle of compound interest. But then what do they do with that money?
they're investing it and making investing 10 times your money for every dollar they have of your money.
It's fractional banking. They've got to get that money in motion, and they only have to keep about 10% of your account there, and they loan all the rest and go make, who knows, 40, 50, 100% on that money as they pay you. I don't know, what's a bank even paying? So many zeros in front of it these days.
Yeah, but it's not even anything worth even saying, really.
Exactly. So again, that's the whole concept behind these policies and the infinite banking is get that fractional banking working for yourself. Get this money in motion for yourself. And then you have these values that you can pull in and out and do many things. I've had my oldest policy is about 16 years old. And I've told this story to clients before, but I recently did a massive remodel on my house. And part of that was I just pulled 150 grand out of my policy and paid cash. Well, of course, it's a perfect scenario right now, but the values went up by so much that I turned around and the value of my home went up by 300,000 to 400,000. So then I did a cash out refi, put the money right back into my policy. And again, this isn't an investment option, right? This is just for my my well-being and creating more for my family and enjoying our house. But it's an example of I took it out, put the money in, it created more, I pulled it right back out and put it back in my policy. Well, the cool thing is 2 weeks later, I had an option to buy a house, a rental property by the University of Utah. It just so happens that I had my daughter that had 3 roommates. They were just dying trying to find a place, and they couldn't find a place to rent. And it was just
so complicated.
So what did I do? I found a place, worked with a local agent that's in the WGR, and they helped me find a place, and we ended up closing on that within weeks. And of course, I needed the money quick for a down payment. I had to pull 120,000 out. And what did I do? I pulled it right from my policy, had it within 2 days, wired that over, and then closed on the house. And now I've got this property that's cash flowing because, of course, my daughter, she better be one of the best managers of that, right? So the whole idea is because I had that value there, now I just leverage that one more time. So in a 2 to 3 month period, of doing the remodel and everything, I've pulled that out and I've got that in motion twice for myself. And I've avoided, going and getting that money from somebody else, paying that interest to somebody else. I'm paying myself.
Right. So when you're in that payback period, for people to have a better understanding too, is like going back to like the $100,000, loan example where, you loan that out and you're getting 12%. What do you do with that money? Like, let's say this is the payback scenario where you are, you're making 12%. So on an annual basis, that's around, $1,000 a month on 100,000 lent. So what are you doing with that? Is that something where, okay, that 100,000 that's out, that $1,000 a month that's coming in and your monthly interest that's due to you, are you just putting that 1,000 back into this policy, or how does that work? And, I'm just trying to make sure we have a good understanding for that.
Well, again, the loan provision allows you to make these choices. And like any smart business owner or any smart transaction, you'd want to get this money back as soon as you can.
Right.
And you don't have to. So what I always tell clients is, if you're getting that on a monthly basis, just get that on an automatic where it's just paying back into the policy. You don't even see it. Again, the goal is to get that money back in there as quick as possible. Mm-hmm. And the reason for that is when that next opportunity comes up, now you've got the full value there to go then and do it again.
Right.
So again, you just have to treat this as, obviously this is your business. And so you want to get that paid back in. Now, if you didn't pay it back in right away, there's no downside to that other than you don't have that value building and you're not accumulating as much as you could because you want to have that, paid back. But it gives you options, because what if that money does have to stay out for, maybe it's a year, maybe it's 2 years before you start, having the ability to pay it back. Again, this is where it's flexible to be able to do what you need to do.
Right. That makes sense. Because I know for me, what I plan on doing is, like, I've lent money in, rentals and fix and flips and things like that for like renovation funds. And like, I look at it as like, okay, say I'm going to keep using the $100,000 example because it's easy math. Say I lend out $100,000 on a big remodel project on a deal, and that money's out for 5 months. If it's at 12% interest, annualized, I should essentially be able to make $5,000 in interest on top of the principal of that $100,000. So I could be compounding into this policy of getting that $5,000 back into this policy on top of all that principal, and then be continuing to just kind of compound that growth of that percentage, dividend on top of what's being contributed constantly as well, right?
Exactly. And again, it's that ability to be able to do that and create that. And yeah, where we have these dividends coming in and the interest, that's just flowing in and help build up the policy as well. And the further years you get into it, you just have more and more options.
Right.
Not to complicate it and give everybody the fire hose effect here, but one of the things people always ask me is, so when can I stop making the payment into this too? See how these dividends over time, they really just start accelerating and getting bigger and bigger and bigger. Anytime we have, so the base policy was around, what was it, 4,500 or whatever it was. It's these two numbers right here.
Yeah.
You can see within, basically 9 or 10 years, there is enough value there that somebody could, I'm not saying it makes sense, somebody could stop making the payment there on the base policy, and it just pays for itself out of this. So again, the further you get into this, you just get more contingencies, you get more options, more flexibility with the policy, that if anything, if there's a hiccup, now you have that protection.
Mm-hmm.
Well, and again, there's many parts, but we didn't even talk about the value of protection and how, 100% of this is protected from lawsuit and bankruptcy too. So that's a whole nother conversation too, is how can we have an asset that is protected from being sued, right?
Yeah. I mean, there's so much on, on this whole infinite banking concept that's just so cool. And I mean, I'm happy to, do even, a couple follow-up videos around this, because it's like, I just feel like so many people need to know this. And, I appreciate you so much, Ira, where, you're willing to share this information and, be willing to put this out on YouTube, because there's not enough people talking about it. And then there's a lot of people that have been burned in the insurance industry by having these whole life insurance policies that get really no cash value. It takes years to get any, and the amount you get is so minimal that it's like not really going to be life-changing for you. And, instead of just having life insurance as a death benefit, to turn this into something where it's an investment vehicle that has the benefit of having a death benefit. Like, that's what I love about this. And, it's such a cool concept to be able to utilize.
Well, and I always tell people this, you talk to if you subscribe to the Dave Ramseys and the Susie Ormans, it's a bad thing, but they're very, very against these. And again, they're teaching and talking to the masses.
Yeah. They're talking to people that have never saved money for themselves in their life. They're talking to people that aren't investors, that aren't sophisticated, that aren't trying to be sophisticated. They're talking to people that are like, please, God, just save $500 for emergencies and stop spending all of your money on McDonald's and, their garbage.
Exactly. So again, that's where when I hear somebody says, well, I've heard whole life's a bad thing. It's like, if you thought something to be true and you found out it wasn't, when would you want to know about it? Now.
Yesterday.
So that's where we're trying to get the word out. That's why we love partnering with people like you, Cody, that are excited and want everybody around them to understand this better so they can just better their lives. And in the end, it's just going to create that much more for themselves and their family and their legacies. Now we've got values built up, with a death benefit, that you're leaving long-term legacies too. There's so many things that can be done.
Definitely. So what would you say for people that are obviously, there's the first video that we did that we just kind of talked about, like, what the heck is whole life insurance in general, just kind of some of the more basics. and then where we talked about like whole life versus term on this call. And then we, kind of got into like how it can be an investment vehicle, like what the chart looks like. I think that was super helpful. Where would you say would be a good resource for people to go to continue learning about this? Or, I don't know if that's whether it's reaching out to you as well, or, what that would look like, Ira.
Well, I would say, obviously, this benefits me, right? I would love to help your group try to understand this better. I'm willing to set up some time to talk through and help people understand where they're at. And everybody's situation is different. I mean, I have people that do, $1,000 a year. I have people that do $100,000 a year. I have people that do $200,000 a year into these policies. But we really just have to identify where they're at personally and what they're trying to accomplish now and for the future too. So I'd be willing to set up a time, and if you just want to share my info, then we can set up some time. But I caution in a way for online searching. It's like anything. You go in and search this, you're going to get all the people that are.
It's almost like searching like my stomach hurts and going on Google and it's like, I have cancer, I'm dying today. Like
Exactly. Not that there isn't good content out there.
Yeah.
There isn't very good things, but you're just going to see both sides of it too. The for and against, which I think is good to help you make your decision, is understanding why people are saying it's not a good thing too. So yeah. I'm happy to take some time with anybody in your group and be able to help them as well.
Awesome. Yeah, I'll definitely make sure that we also put in the description your contact information, that people could reach out to you as well if they want to get on a call with you and see if it's something that would make sense for them. These last couple of minutes here, Ira, do you have any kind of closing thoughts around like that from what we talked about today that you'd want to leave everyone with?
Well, again, I just would say there's ways that the banking industry works, and it's the whole fractional banking. They tell us that's how it works. They tell us what they're doing, but we just subscribe to the let's money and get this miracle compound interest. Let's start thinking differently. Let's start thinking that there's other options out there. Again, there's real estate, there's there's all kinds of investments you can choose, but the value of having a whole life policy as your foundation, it's just all guarantees. That becomes kind of the foundational piece of that financial house. And how can we build on top of that and go do all these other things? If it's real estate, if it's Bitcoin, if it's invest in the stock market, any of these things are options. Let's just enhance it by running it through a policy first, where then we're creating these multiple options and multiple returns for yourself and not for other institutions and other people.
Awesome. I love that. Yeah, I'm so excited. And, this is always a fun topic to talk about with you and, sharing with everybody. So we'll definitely, I think, like you said, we could even do another piece around, some of the other benefits, like, protecting yourself from creditors, protecting yourself, in a bankruptcy situation and how that works and what that looks like. But, Ira, I really appreciate you being on here. And for everybody that's watching, if you have any questions around, this topic, or you want to see more content specifically around this topic, make sure to comment in the comment section below. And if you got any value, if you didn't get any value, you must have not been listening, because this was a ton of value, guys. So make sure to like, subscribe, hit that notification bell, and we will see you in the next video.